What is construction financing? Construction financing, also known as a construction draw mortgage, is a mortgage that is advanced over time based on the progress that's being made. So for example, if you're building a home or you're building a building, instead of borrowing all of the money at once to build that structure, you can borrow the money over time. You can borrow the money as the foundation is poured. You can borrow money once the framing is done. You can borrow money once the walls are in. And the reason it's called a construction draw mortgage is because you will request draws from the bank or the lender based on the progress that is being made. So you tend to save a little bit of interest because instead of borrowing all of the money you need at once, knowing that it's going to take half a year to a year or more to finish construction of your particular project, a construction draw mortgage allows you to only take what you need as you need it. The mortgages tend to be interest only, and I'll compare that to the other type, which is what's called an amortized mortgage. So with every payment that you make, a little bit is interest, a little bit is principal, and over time, 20 years, 25 years, you end up paying the entire mortgage down. With an interest-only mortgage, it works more like a credit card where you'll have a balance, and then based on a certain interest rate, that's the payment that you make. And there is no principal, it's only interest. And construction draw mortgages or construction financing tends to be priced based on interest-only payments. Once construction is done, then the mortgage will convert into, or many times, the construction mortgage that you had will end up converting into a more traditional amortized mortgage over 20 or 25 years, or if you're building a building, maybe 15 or 20 years. When you get a construction mortgage, you're going to have to produce a budget for the bank. And the bank is going to want to see three basic categories in your budget. They're going to want to see, what did you pay for the land? What are your hard costs? And what are your soft costs? So land is pretty straightforward. Or hopefully it's pretty straightforward. That is the physical piece of land that your structure is going to be on. And so the bank's going to want to know, how much did you pay? How much are you paying for that? Then they're going to want to know, what are the hard costs and what are the soft costs? And hard costs, the easiest way to understand it would be anything that you can see on the structure is a hard cost. Wood, nails, drywall, shingles, flooring, plumbing, wiring, those are all hard costs. And then soft costs would be anything you can't see in the structure. Legal fees, appraisals, permits, drawings, architects, interest, bank fees, all of the kind of the soft stuff. So when you put a budget together, you need to know your land, your hard costs, and your soft costs. And the banks tend to like to fund land and hard costs because those are tangible assets, or they have tangible value. Soft costs tend to be a little bit more arbitrary. And to give you an example, a home that I was involved in constructing, we had paid a couple of $1,000s to have some floor plans drawn for us so that we could give them to the trades so that they could build the home. Well, I know from other projects that I've funded that sometimes those costs can be tens of thousands of dollars. And so the reason banks don't like funding soft costs is because it's very difficult to try and figure out, okay, what is the true value of this particular cost? When they talk about land, banks can say, well, there's lots of other pieces of land that we can look at and we can sort of get a handle around what the cost is. And wood and nails and drywall, we can kind of understand that those costs are what they are, concrete, etc. But soft costs tend to be something that the banks do not like funding, or if they fund it, they'll only fund a certain line items like interest, for example, but they tend not to fund legal fees or appraisal costs or architects or permits or anything like that. So when you get a construction draw mortgage, you should know that the interest rate might be a little bit higher than what you would normally expect for a mortgage when you see mortgage rates posted everywhere. Construction mortgages tend to be a little bit more expensive because they require more work on behalf of whoever the bank or lender is to manage it. And you're going to find that there are probably going to be some fees associated with it. Some of the banks will charge up to 1%. Private lenders will charge, you know, a couple of percentage points for the fee. Mid-market lenders, the same thing. So when you're looking at a construction draw mortgage, just be aware that it may be more expensive than the traditional mortgage that you might be used to getting.